Investors normally expect to receive higher yields for buying funds focused on bonds with longer maturities. After all, it just makes sense that the issuer, that is a government agency or corporation, offers you a higher rate of interest to own a piece of its debt that matures over a longer length of time. But such normal supply and demand dynamics don't always hold up. Although few and far between, when this takes place, say 10-year Treasury note yields fall below that of a sister 2-year notes yield. It's referred to as a yield curve inversion. Today, we're fortunate to have Phil McInnis on hand to explain exactly what a longer term focused investor should make of news headlines about yield curve inversions. Phil is a chief investment strategist at Avantis. Before joining Avantis in 2019, he was a vice president and head of portfolio solutions at Dimensional Fund Advisors. Hi, Phil. Thanks for carving out some time in your busy schedule for us today.
Hi, Murray. Absolutely. My pleasure. It's great to be here.
Now, a yield curve inversion is a statistical term, right? How does it relate to an investment portfolio's longer term risk and return profile?
Yeah, that's a great question. I think anytime you hear the term, yield curve inversion, if it's thrown around, people either their eyes glaze over or they get a little bit nervous, right? Trying to understand what it means. And I think it's useful to maybe step back and think about a yield curve just in general. What is it, right? How does it work? Because when we think about, say, the equity markets, where we look at stocks and their trading and you can constantly see their prices, I think about a yield curve for bonds as being somewhat similar, right? A yield curve is basically an expression of prices for different debt instruments with varying maturities, right? So when you think about the idea that you were talking about with shorter term versus longer term, typically what you see with that yield curve, that collection of prices, what are being expressed as interest rates, it's upwardly sloping, meaning the shorter term debt tends to be a lower rate of interest that you're getting paid to hold that debt. And then for a longer term instrument, something out there 5 years, 10 years, 20 years, 30 years, you have governments that issue 50-year bonds, right? Further out, you're getting a higher rate of interest. When it inverts, the short-term rates are actually going up above those longer-term rates. So you're actually getting paid more to hold shorter-term debt. And what sort of circles around, I think, in folks' minds is the concept of, well, what's causing that? Does that mean potentially that the longer-term prospects for the economy are not very good? So investors are willing to basically take on and hold lower rate of interest debt right now for the longer term because they can really lock in that rate. So there starts to be a little bit of concern that comes from that. So for us, we always think about just sort of stepping back and trying to think about that broader picture of, well, a yield curve inversion might be happening, but the exact impact on my portfolio and what I'm invested in and my goals as an investor over the long term might not be impacted nearly as much as I might think, if I don't understand the connection between those two.
Yeah, doesn't an inverted yield curve basically just mean that the risk return profile of your portfolio is going to be different for a short term at a time?
Yeah, I think so. It really goes back to, the idea of if you think about where you're putting, your capital to work, right? If you think about an overall asset allocation, many investors, they're going to deploy some capital to equities, they're going to deploy some capital to bonds or fixed income. And so if you think about, you could go invest directly in treasuries, right? You can go and just buy treasuries directly. You can also invest in funds, right? Mutual funds or ETFs, what have you, that are going to go buy debt instruments of various maturities. And so you can get exposure to a whole lot of different securities in a single fund. So what you see is, there's a lot of different offerings out there with different duration levels, different levels of credit risk. And a lot of the advisors we work with and a lot of the advisors, I think, that you work with, what they're going to be doing is evaluating those different funds and figuring out, well, what's the right level of duration and the right level of credit that we think makes sense for that investor alongside with their goals and the equity risk they're taking and everything else. So that's sort of being determined for, for you as the investor relative to your goals over the long term. And so while the risk return trade-off, if you're thinking about I've got new cash to invest today and I'm not exactly sure what I want to do with it, then you might have a different evaluation of, well, what's this, what's the shape of the yield curve? Where am I getting a certain rate of interest? I only need to hold something for a year. I'm getting paid, let's just say 5% to hold this bond for a year. That feels like a good trade-off to me. I'm happy to do that, right? That's kind of a specific instance, but again, trying to step back into those broader goals that you have, I think it's really important to try to get that context of what's happening with the yield curve relative to what you might be trying to achieve in your portfolio.
Sure. And let's define duration too for people out there who don't
Yeah,
know.
sorry, I used a jargon type term. So duration is sensitivity to interest rate movements. So when you look at the duration of the bond, it's basically trying to tell you, well, what's the basically the time frame that you're going to get paid back on your money for. And the longer the duration of the bond, typically that means the longer the maturities of those underlying instruments. And so a longer duration means you have more sensitivity to changes in interest rates typically, meaning the prices of those bonds are going to move more as the interest rates change.
Yeah, and since trying to outguess interest rates is kind of a folly, IFA is very, very steeped in trying to keep uh, investors' portfolios on the bond side as safe as possible.
Yeah, when I think about, yield curve inversions, we actually wrote an article about this. It's actually a little bit, it's almost a year ago now, but the reason I think about it is we just came through March Madness, right? And there were a lot of upsets that happened in the tournament, some higher seeds really kind of making their way pretty far into the tournament. And as we were looking at the potential for the yield curve to invert a little more than a year ago, you saw the yield curve sort of flattening, right? So as those shorter term rates were coming up, instead of being very upwardly sloped, the yield curve got flatter and flatter. And so we were kind of equating, the idea of a yield curve inversion and for finance geeks kind of being an upset, right? It's like it's not something that you see every day, and so people are paying pretty close attention to it, similar to like an upset in March Madness.
Sure. Okay. Well, thank you very much for your time again, Phil.
Absolutely, really great to be here, and hope you have a great day.